We welcome on board Ajay Bagga as well and find out what he's making of the market right now. Ajay, hi, afternoon. Good to have you on the show as always. Ajay, do private banks and the underperforming ones especially seem to be the only value zone in the market right now?
Not exactly. There is a lot of defensives available like IT, like pharma as well. So not exactly only the private banks, but this week has been the flavor has been the private banks, and Bank Nifty has performed very strongly this week. So there is a catch-up trade happening with the large private banks. Today we have seen a bit of a volatility, but it's all under 1%. Par for the course, the market is digesting some of the up move that it has made post the 4th of June. So I think this should continue. The large private banks, recapturing their previous, numbers in the stock market pantheon. I think that should continue, Aisha. But in terms of value, there are quite a few sectors which are underrepresented in portfolios like IT, like pharma. Some of the FMCGs, again, they're not the traditional value plays because the valuations normally are high for them. But again, in terms of ownership and the outlook, there should be a consumption boost post the budget. And if the monsoon turns out to be normal, we could see some of the traction returning to the consumption plays. So I think those are available with respect to, say, a railways or a defense, which is a very highly overvalued story, or even the public sector companies as a cohort, which have become quite highly valued.
Right. Other than that, Ajay, what are the pockets that you're recommending to completely overlook and avoid right now? And would IT fall in the same bracket? Although there is some excitement on IT because of the Accenture numbers, but it's really not an apple-to-apple comparison.
Yeah, still early days in IT. I think you can wait it out for a bit more. How eventually this will play out, Aisha, see, if you look at the AI, the entire AI set, there are the enablers like the semiconductor companies who have done very well. And then there are the companies who will directly benefit. Between them is the Indian IT companies who will enable those chips to be rolled out into data centers and write the programs which will help the end using companies to use AI. So that model is still under evolution. There have not been much gains in that. In fact, on the contrary, the size of the order flows has started coming down in IT because companies are not willing to give very long-term orders or very large orders, given the way AI is disrupting the entire industry. But I think over time, and over time, I don't mean 5 years. I think within the next 1 year, you will start seeing the first case studies coming out where Indian IT companies start enabling the hardware, the hardware gains to come into actual industries via some software. And that's where I think Indian IT will start scoring. Probably we can wait it out for 3 months more. But I think we are pretty much done in terms of bottom formation in the IT sector. So if you have a longer term perspective, I think with a year, 2 years perspective, even now some amount of participation can start. And then let's wait for the results starting another 15 days. That will start providing us some guidance. But I think that's how we have to see it. On one side, the hardware, other side, the user industries, and the enablers in the middle. And that's where the Indian IT will eventually play a role. Still early days, we are not getting much traction or much commentary from the managements on that. So will that come via some acquisition? Or will that come via some case studies where they actually implement it? I think we'll have to wait and watch.
Yeah, wait and watch for the IT companies.
But Ajay, what's your opinion on defense and railways? Definitely not put fresh money to work right now, is it?
Yeah, Aisha, if you see the kind of moves that's happening, last 2 days we saw fertilizer stocks going up very strongly on talks of inventory getting written off and getting cut into and more business coming through. We are seeing some incipient work happening on the chemical side. And some good news coming from Europe also in terms of patents coming through on chemicals by the MNCs, and that should help the entire food chain. But if you look at railways and defense, already run up so much, and multi-year order books have been factored in. Now it's the execution challenge. So have the investors already eaten the pie for railways and defense? Not fully, but right now I think there might be one more move up, like we saw in railway stocks today. Going into the budget, there will be some talk of defense capex increasing, indigenization increasing. They will be beneficiaries of that. But to a large extent, at these price earning ratios, I think at least a 1 year story has got baked in. Now, markets are always forward looking. So, another 3 months, 6 months, there will be a new story on or new order books coming in. And that will help the stocks eventually to rally again. But right now, at best sideways, and at worst, you could see a healthy correction given the lofty valuations and how everything has got baked in. And now they have to just execute. So you're not having much of a driver in terms of defense stocks, especially. Railways, again, there will be a focus in the budget, and you will see this kind of a rally nearer to the budget again. But I think most of it is baked in, and you might be better off in some other sectors than these lofty valuation sectors.
But Ajay, in terms of market triggers now, what's next? Or do you think the market is now only going to be hooked on the FII flows trickling in?
No, I think a very important date is 26th June next week, Aisha, on the Speaker of Lok Sabha. I think that will point towards the strength of the political capital that the ruling party is enjoying. So that remains a very important event. And if a BJP, preferred speaker comes in, I think that will give some amount of relief to the markets in terms of political risk outlook. So 26th June is important. And then we'll get into the results and the union budget. A lot of chatter on the sidelines on the union budget. And, that sets us up for more disappointment. Like if you read through the MSP hikes, the government has been quite conservative in that way. And what my talk to a few knowledgeable people is that really they'll not be spending political capital right now in year one for a few state elections, but they will look at a broader contour. And for that, it's too early to really bring out much in the budget. So I think we are getting set up for a bit of a disappointment, but the market has factored in that if we maintain the capex, the public capex, if we maintain the 5.1 fiscal deficit number, more or less it tick marks for the market. And FIs, fortunately, now last few days we are seeing a positive flow that should increase, especially on the debt side. We have seen good flows coming in, and by the end of the month, so as early as next weekend, we should have had some very strong debt inflows coming in that should help the rupee, should help the RBI bolster its FX reserves even further, and it will help the yields to go down. So some part of the RBI rate cut work will be done by the flows on the debt side. On equity, we have to really still see how soon the US cuts, and that will be a big trigger for emerging market flows to take off. And in anticipation of that, around September, you could see FI flows picking up even more than what they are right now. But I think the change has happened over the last 15 days as the political risk has reduced considerably. The uncertainty of the event has gone, and we are seeing FI flows coming back. I think that should gather momentum. But the big momentum, big boost will come when there is more clarity on the Fed cut, and then emerging market flows come in, and we'll get a good portion of that coming into India.
Point taken. So that's the view coming in on the market mood right now.
If you like this video, then like, share and subscribe to ET Now.